So last month, when we spoke about things going on in the market and in the economy, we talked about our hope that the Fed would not ease policy on December 10th, but we knew they might, and they in fact did. We got an interesting cut yesterday, really, because as you parse through the statement and then listening to Chair Powell navigate the press briefing yesterday, it sounds like some very mixed messaging coming from the Fed and really demonstrates how uncomfortable they are at this point in the cycle with the fact that their dual mandate sits in such conflict. We don't see the labor market deterioration that they do. Chair Powell mentioned shaving off 60,000 jobs a month from the reported numbers. That seems very aggressive from what is available in data. But nonetheless, that's the view of the Fed, that the labor markets are in trouble and the Fed needed to rescue through a series of cuts through the back half of 2025. However, as he turned the conversation to not really as much inflation, but more about the prospects for better growth in 2026, which, by the way, you may recall is something we do agree with, he started to talk a little bit more about hesitancy in further cuts, saying that they really are at the neutral rate, upper bound, but at the neutral rate right now. But the markets didn't seem to hear that. We had a rally last night, we had a rally into today, and we continue to see yields are moving lower despite what the Fed said. When you look at something like the expectation for future rate moves by the Fed, it's showing right now the market is expecting 2 cuts in 2026, when we just got a fresh set of dot plots that said the Fed's looking to do 1 cut next year. So it looks like we're set up for another period of time where the Fed will stay right in the center of the story as it relates to the fixed income markets. There's certainly the AI technology story dominates in equities, but for us bond investors, staying laser focused on what the Fed is thinking is going to be a continued theme in 2026. But the other part of the Fed that gets interesting next year is what it looks like. We know that there are going to be some changes to the makeup of the Fed, and that is something we'll be monitoring very closely. We don't have the nomination of the new Fed chair, and we are expected to get that in early 2026. We know there are some seats to potentially fill next year as well, and we know the regional bank presidents come up for re-election. So there's going to be some interesting moments that will certainly grab headlines and potentially move markets. And as I said, we'll monitor those. But in the meantime, our macro forecast stays pretty much the same. We still think that there is the potential for decent growth next year. As mentioned, we talked about the fact that the One Big Beautiful Bill Act will contribute to that. But CapEx spending is going to contribute to that as well. And we're coming into the year on pretty decent footing. But thinking back to a Fed move of cutting rates when we don't really know what's happened in the fourth quarter, that does still get kind of interesting. Even the Atlanta Fed is not willing to put out their GDP nowcast for Q4 because they don't have the data to support it. Yet we had a Fed that felt like they could cut rates. So here we are with a little bit of mixed messaging on monetary policy, a growth picture that's set up to perform pretty well. Labor markets that seem to be, yes, softening. We still agree with that part of the messaging, but we just don't see the cracks that lead to more Fed policy easing. And inflation that remains still at that pesky 3% number, well above the Fed's 2% target. In the SEPs and the dot plots that we got yesterday, the Fed again pushed out their expectation for when they could achieve their 2% inflation target out for another 2 years. It seems to be a theme that they have because they realize they just can't quite get there yet. So inflation remains something that we are very focused on. We don't think it's at a point of being runaway where the Fed has to actually raise rates, but it does limit the amount the Fed can ease policy, which also then limits the amount that the overall Treasury curve can move lower. And that is a piece that we think people might be getting wrong right now. If there are fewer Fed rate cuts, if we're right about inflation and growth does come in as strong as we are expecting, then there's room for the curve to steepen, providing opportunities further out the curve, again, that we had enjoyed for part of last year. But as we look at the entire investing picture, it does come back to the same general theme. All-in yields for income-oriented investors remain pretty solid, staying up in quality, avoiding some of the idiosyncratic risk that is out there with M&A activity picking up quite a bit. Those are definitely things that we're watching closely and navigating as we can through these markets. But in the meantime, our focus does remain predominantly on structured sectors. We think that's where the best value is, especially combining quality, duration needs, and all-in yield, and we're neutral on credit. Fundamentals are good, supportive, but spreads are tight. So not much change in terms of how we're approaching markets and getting ready for some potential changes as we turn the calendar to 2026 when we think about the broader macro backdrop.